This podcast is general in nature and hasn't taken your circumstances into account. It's important you consider your personal circumstances and speak to a financial advisor before deciding what's right for you. Any general tax information provided is provided as a guide only.
Hi everyone. Hi Shane.
Hi Diana.
So we've missed you. You've been on holidays in Fiji. How was your trip?
It was very good.
And you were spotted by a client or a financial planner there.
I did. I was incognito. I was wearing my Reflecto sunglasses, hoping people would just see themselves in the sunglasses, a funny hat and a giant tie-dye with a love heart on it.
So you were not really incognito, sort of the opposite.
No, but my theory was that if you're so crazy looking, then people will assume that it's not me.
Yeah, but they'll look at you.
But they might, but they probably conclude that it's not me. It couldn't be the economist dressed like a nut. Like that. So I thought I was in
maybe
disguise.
it is the economist always dressed like a nut. A lot of people think
maybe.
economists are nutty characters.
Yeah. But normally economists are meant to be sensible people wearing suits like this and a sensible tie, like I always wear.
And we had another follower on our social media yesterday texting us saying, did I see Shane on the plane going from Sydney to Melbourne? They were very excited that you were sitting in the row in front of them, but they didn't say hi to you, sadly.
Yeah, they should always say hi. I won't bite.
So on to more important things. Share markets were actually up over August, even though it was seasonally a weaker month. But in September, we've seen a weaker start to the period.
Yeah, I guess you got to put it in perspective. It's only slightly down. Bit more in Australia, maybe because we haven't had the strength in profits that the US had. But by the same token, we do know that from history that September is a softer month in share markets. In the US, I think it's known to be the weakest month of the year. There is some confusion around that because if you have a rising trend going into August and September, we know August was actually good. If you have a strongly rising trend, then it tends to be the case that maybe September's not so bad. Maybe. But by the same token, the market has got technically overbought. Valuations are a bit stretched. There's a bunch of issues out there causing consternation. Global debt levels are a concern again, particularly public debt, given the issues in France trying to get their budget deficit down, which seems to be failing yet again. And of course in the US with Trump's tariffs being rejected again by another court, creating more uncertainty. And the reason that's important is because the tariffs are sort of being relied on by the US government to offset the tax cuts in the One Big Beautiful Bill Act. So the budget deficit doesn't blow out too much. But if your tariff revenue has to be hounded back, then that could be a bad thing as well. So you got this backup in bond yields at a time when shares are a bit stretched, and that's why I think shares have come down.
At least bond yields are not, nearing 5% like they were about a year ago in the US. That was sort of when investors got really concerned about public finances. It seems to be more of an issue in Europe.
That's right. I think it is more of an issue in Europe. And it's interesting the way that the French bond yields are going up so much that soon they might even surpass Italian bond yields. Who would have thought? But that's the way it's going. But I think, I was just complaining that I've been away for 3 of the last 4 weeks. So I haven't written the weekly. I was in China 1 week and then in Fiji, and you and me wrote most of the weeklies through my favourite time of the year, which is the profit reporting season. And much better in the US, I must admit. Profits turned out to be up 11%.
But that's only because of tech. The tech sector was up 30%.
I know it was mainly tech, but nevertheless, the expectation was for a 4% rise at the start of the reporting season. It turned out to be 11%. In Australia, not so good. Profits were down about 3%, the third financial year in a row of falls. Again, you get this similar dynamic. You get this big drag from resources, a bit like the US. Tech profits are up, but tech in Australia is such a small part of the market that in aggregate you get a fall, whereas in the US you get in aggregate a rise. But the thing that got me kind of excited, and you got to talk about this for the graph in the weekly, was that we've now got slightly more than 60% of companies actually reporting profits and dividends up on a year ago, which is looks like it's starting to hook back up, which gives me confidence that we've probably seen the worst in terms of profits, and we should start to see profit growth over the next 12 months.
That probably, though, goes to the point that, the US, in the short term at least, is still probably going to outperform Australia because at least share markets and prices are really driven by profits, whereas in Australia it's only really what they say PE expansion, not really profits that are driving that fundamental rise.
Yeah. It's hope of something better or hot air. Some degree. So you do actually want to see those profits come through, whereas in the US they have been seeing, in aggregate anyway, the profits go up. But, I mean, this brings me to this other question, which you wrote on recently when I was away on US exceptionalism. And we all know the US has been a star performer for the last few years. But you had a good note on 3 reasons why that might be coming to an end. Potentially.
I did. That was after my debate with the AI economist.
So it wasn't a robot. It was just a computer you were debating.
Well, it was a robot. It was like a chat GPT version of
But you were talking to a computer.
I was talking to a phone. Yeah. And actually, initially when I started that, I was meant to take the bullish side. But then we had a bit of confusion about who was debating what. So I ended up taking the bearish side, which I thought was more interesting anyways. And I think that over the next 75 years, I mean, it'll be really hard for the US to continue outperforming. And I had 3 reasons why I thought that they would underperform, or maybe not even underperform, just perform on par with our other major peers like Europe,
75
emerging markets.
years is a long time.
It is. And actually, since the beginning of this century, the US and Australia have had the same returns. It's really only been the last 15 years that the US has outperformed.
Yeah.
So my 3 reasons for why I thought they would underperform in the next few years would be, well, one, that the US is removing everything that used to make it exceptional. So, I mean, there are a lot of components to that. Some of it is driven by Trump's policies, but a lot of it started even before Trump, like not enough investment in the green or the new economy, not enough investment in research and health. And I think that the Trump administration is accelerating those trends. The second reason was that the US is no longer the global hegemon, which is basically that China and India have surpassed the US in terms of growth and contribution to the economy. And the US is going to decline as a share of the global economy. That's right. And the third reason is that the US dollar looks under threat. And you can sort of debate this one to no end, really. But I think at the start of a digital currency or a central bank currency, it may be the end, not the end of the US dollar, but we'll see some further decline in the US dollar. And the US dollar has already had a shocking start to the year.
It has. And gold, I mean, it was Bitcoin went to a record high a few weeks back. Now gold's gone to a record high, which is telling you something. There are concerns about the US dollar.
Yeah. After also having a positive year last year for gold. I think it was an outperformer last year too.
I mean, the funny thing I think about the US is that as an economist, you think a lot of the things that Trump is doing, we have issue with. You know, the US government buying a share in Intel. Intel's been struggling for a long time now. How is the US government owning part of it going to fix that up? You know, you're better off letting the free market work it out. Or the intervention in the Fed. I mean, governments always intervene in the central bank to some degree, but to intervene in such an overt way, which makes markets think, well, maybe they're not going to be as anti-inflationary as they used to be. Or imposing a 15% tax on NVIDIA if they export chips to China. The US wants part of the action. Tariffs, which block free enterprise, or the constant chopping and changing regarding the tariffs, which leads to uncertainty, the attacks on the universities, and so on and so forth. All of those things, you could argue, well, they may not have much negative impact in the short term, which is partly why markets are sort of looking through the tariffs and there's been no panic yet, but they could act as a dampener longer term, which goes to your point about US exceptionalism could come under pressure, because I think the US is doing so well because it is just so dynamic, whereas Trump's policies could actually work against a lot of that.
And it's really the tech sector that's been driving that exceptionalism and the strong rebound in productivity growth in the US, profit growth and economic growth too, because all these companies have been investing in AI and in data centers. But if that is no longer a growth lever in the next few decades, then what is going to be? And also, what's not to say that other countries aren't just going to replicate that technology like we saw with DeepSeek for a much cheaper rate and do the same thing as the US. I do have a lot of issue with what's going on with the Fed, though. I mean, first the attack was on Powell, and obviously they didn't have enough to get Powell, so now they've attacked Lisa Cook, one of the other Fed officials, for saying that she's done some dodgy things around her mortgage applications. But it looks like it may actually be blocked by the Supreme Court, and a lot of economists have come out against it as well, because it does really question the independence of the Fed.
Yeah, I think many economists and market types like us sort of think, oh, well, the Fed's got all these protections. You know, it's got the governors, 7 governors, and then it's got the presidents of the regional Feds in the US, and they rotate in terms of participating in the interest rate committee, which is the FOMC. And then now you've got this situation where Trump had actually already appointed in his first term a couple of Fed governors. That's Waller and Bowman, I think it was. One of them, Adriana Kluger, I think, stepped down and he's replaced her with someone called Mirren. And then now there's an attack on Cook. And that obviously has to be determined in the courts ultimately. But as you say, it gets if that goes ahead, then 4 of the 7 governors will be controlled or will be Trump appointees. And they also have the potential, because they will then dominate, to override the replacement of the regional presidents.
Yeah.
So therefore you could weaken the perceived independence of the Fed. Like in some ways you could sort of say, well, who cares anyway? You know, when it's an arm of government, they're still independent.
Yeah.
I guess I care because I was around in those times when the Fed was heavily influenced by the government, Nixon in the US and in Australia, where it was the RBA was directly controlled by the government in terms of what they actually did on interest rates. And it didn't work out so well. So that's why I prefer this sort of quasi-independence, although they're not totally independent. So it does worry me a little bit. But of course, the markets will sort of have mixed views on this. They'll say this could be a long-term concern, but it could take a while to play out. In the meantime, we might get low interest rates, and the share market likes low interest rates anyway. So you could go through a phase where it's not even a problem. It only becomes a problem, several years down the track.
It seems like nothing's a problem for markets, but at the same time, we haven't really had poor economic data, especially coming out of the US. Things have mostly been okay, not any signs of a serious growth downturn. So maybe if we get those sort of signals, then that's when markets will really start to worry about growth.
That's quite possibly the case. I mean, I get a little bit nervous about the backup in bond yields because the equity risk premium, if you define it as the inverse, this gets complicated, inverse of the forward PE, you invert that. And in the US, it's you get an earnings yield there of about 4.5%. The bond yield's around 4.5%. Now we're a bit less, and the risk premium is close to zero, and it's not much better in Australia. And so if bond yields keep rising, then obviously it puts more pressure on share markets. So that could be a bit of a concern there. But I'm also conscious that we've gone through these concerns about global government debt every so often, and then it sort of flares up for a while and then backs away. There's also an argument that there is a seasonal uplift in bond yields around this time of the year, so you shouldn't necessarily read too much into it.
And on Australia, we got the June quarter growth figures recently, and they were actually a bit better than expected, up by 0.6%. Economists looking for a bit lower.
So we started at 0.6.
Yeah.
And then we and everybody revised down to 0.5 after some softer data, but actually came in at 0.6.
0.6 or 1.8% over the year. So that was a pretty good outcome. The RBA was looking for 1.6%, and 12 months ago we probably had growth tracking a little bit lower. So I think it was a pretty good outcome, but a lot of the components in it were driven by private consumption or household spending and a lot of one-offs to that. So I'm not sure if this is going to be repeated again, at least over the next 6 months. So maybe growth will just stick at 1.8% and not really track much higher from here.
Because if you run through them, there was in defence, government consumption boomed because of defence, and there was defence exercises.
Military exercises, your favourite things.
Yeah, well, we shouldn't be doing that. I always get worried about that sort of stuff. Military parades, people wrapping themselves in the flag. Anyway, it's a bit of a sideshow.
Well, it's sort of an unproductive area of spending.
It is. I think that money could be spent far better somewhere else. And economists, I don't see any value in it. But the problem is that you can make an argument that Australia, like other countries, has been threatened over the years, so therefore you've got to maintain defence spending, which is the logic behind it. So, but if you look at consumer spending, you had Cyclone Alfred disrupting things in the March quarter, and then you get the spending to recover from that in the June quarter. Then we had Nintendo
Switch.
Yeah, whatever that was.
It's a new gaming platform.
I missed
an upgrade.
I'm still with Game Boy. Was that the one in the 80s? The little thing here that you have. I was on the plane. That plane back from Melbourne the other day that you were talking about, there was someone sitting across from me with one of those. I thought it was like a Game Boy thing from the 80s.
It's probably a Switch.
It could be a Switch. Maybe I should get one of them and try them out. I have read somewhere that if you want to stave off Alzheimer's, you should get into computer games. Like I always poo-poo them, and this idea of young men in their rooms playing games strikes me as kind of sad. You should be out there with your billy cart or something. But there is a benefit. I'm thinking maybe I should take up computer games so it keeps my brain active.
It's not a bad idea. Yeah. Instead of Sudoku, yeah.
Instead of Sudoku. But maybe worrying about Trump and share markets does the same thing, perhaps. But anyway, we had in Nintendo Switch, whatever that was, we had EOFY, end of financial year sales, Anzac Day, like all of us, I think all of us, you, me, Boo and me, took that period off.
Yeah.
And what do you do
and
for
all
some
Australia
of that?
did too.
Yeah, and what do you do for some of that period? Well, you go to the shops and spend more money. Whereas previously, there's a bit of a gap between the two holidays and you wouldn't have had that. So
also, people were spending more on medical services because it was a bad flu season.
Oh, dear.
And that's why government consumption went up too, because there was more bulk billing spending on the flu.
So you could see a bit of a slowdown in that consumer spending. But nevertheless, it's good news. 1.8% growth, I think, was the strongest since September 2023. But I guess the big question is, does it stop the RBA cutting rates again?
Well, probably not, because growth is still a little bit below where they'd like it to be. I mean, the trend numbers that they have themselves is somewhere at like 2%, maybe a little bit higher if you assume that productivity growth recovers a little bit. And if the inflation data continues to run at 2.5%, I think that there's still a case for lower interest rates, because the RBA said themselves that rates are still restrictive technically. So I don't think it prevents another rate cut, but it's hard to see one at the next meeting in September. So that's why I think that the November rate decision is still going to be very much live, and I think that they will cut rates again if the inflation data comes in as we think it will.
Yeah. Because while I was away, the inflation data also surprised on the upside.
So that was the July monthly consumer price indicator. It's called an indicator for a reason, that it's not the full set of inflation
figures. But it soon will be the full.
Well, when everything is surveyed, but even the ABS said that will still take time for them. It starts in November officially, the time period when it's meant to be a full reading.
So that's for the October CPI,
yeah.
I think, yeah.
But the RBA said that it will still take them a while to sort of read through the seasonality and the volatilities, because the headline number is not seasonally adjusted. And that spiked higher again for some strange reasons, like the electricity rebates started a bit later for people, so we thought that would have been a bit more of a drag. And some of the consumer durables were a bit stronger as well. But again, because it's a monthly, not seasonally adjusted indicator, I'm wary of reading too much into it.
Yeah, fair enough. I did hear, this was in that Melbourne trip, I actually went to Torquay, which is a great place. I think if you're into surfing at any point in your life, you'd know the significance of Torquay and Bells Beach and Rip Curl. Rip Curl was actually founded in Torquay in Australia. So anyway, on the way there, Nick, he was driving me because he lives there and has his car there, and he was playing this podcast, and the guy on the podcast says that 35%, it's gone from 10% of the US monthly CPI is imputed to now 35% imputed, which is sort of like our CPI indicator in a way, that as things stand at present, a bunch of it is imputed. Imputed means that you don't know what it was in that month because you didn't do a survey in that month, so you impute a number from the previous month to fill in the gap. So it looks like, when we get a monthly CPI, it may be more high quality than the US one because it will have a full survey for each item.
Why has there been a big increase in the US?
Because the budget keeps getting cut back on US BLS.
So those components are never actually surveyed. It's not like there's a delay in them; they're just not surveyed anymore every month.
That was my understanding from it. I probably have to look into it a bit further, but there has been big budget cutbacks in the US, which is affecting the reliability of the data.
Yeah, and not just the CPI. We've been talking about that with the labour data.
The payrolls, and of course Trump will blame. He will be happy with any strong number or any good number, but not a bad number. And that, unfortunately, it was a bad number, so he sacked the messenger. But anyway, I think we've gone off the track. So, anything else to talk about?
Not from me.
That's good. Anyway, it's been fun. I did think of one thing. A few podcasts ago, Boo and I were talking about rice. And I think I got into the benefits of basmati rice because it's got a low GI. But what I found recently is that you're far, far better off having not just basmati, you should have basmati brown rice because it processes the glucose far more slowly, and therefore your body adjusts more healthily.
Has that had the same increase in prices?
I didn't look at
as
the
other
price.
rice?
But you'd think that brown rice is cheaper than white rice because there's less processing involved.
I don't know. But they always charge you more when you get brown rice, like at CaliPress.
Yeah, I can never understand that. You go for the healthy option and it always costs more. There's just no logic to that. If I buy soy milk or oat milk, it costs me more than the cow's milk.
That's because there is more processing involved in that.
Is there? I thought they just put it in a bag and then with water it just soaks through or something.
Well, I think there's more steps involved than milking a cow. But
yeah, but with the cow, you've got to have this cow growing up over time and maintaining the cow and all that sort of stuff. So you'd think there'd be more cost involved.
You also probably need more of the soybeans or the almonds to actually make the milk.
It could be. Anyway, I think we've gone off on a sidetrack here. We'll investigate the relative price of brown rice versus white rice for next time.
We should make like a CPI index of how being healthy
stuff
impacts you.
Yeah. And the sad thing is we'd probably find that the healthy stuff costs you more than the unhealthy stuff, which is a bit unfortunate. Anyway, it's been fun. See you next time.
See ya.
For more info on Shane and Diana's podcasts and reports, head to the Insights Hub at amp.com.au.